Welcome to The Explainer. So if you've been paying any attention to the massive AI boom lately, you probably know that the biggest bottleneck right now actually isn't software at all. It's physical infrastructure. Today we're diving into a really fascinating presentation from a company sitting right in the middle of one of the most aggressive digital transformations we've seen in recent years. We're talking about IREN and their massive, explicitly stated pivot from a traditional Bitcoin mining operation into what they're aiming to be, a Tier 1 AI cloud service provider. We're going to do a clinical teardown of their strategy, their numbers, and the roadmap they've laid out for investors.
I want to kick things off right here, because this number, it's the absolute anchor of management's entire argument. $4 billion. That is the amount of contracted annual recurring revenue, or ARR, that IREN says they have already secured. And we're talking about signed contracts with absolute tech giants like Microsoft and NVIDIA. It is a staggering figure, and it completely changes the context of everything else we're going to look at today.
The sheer scale of this transition is just wild. On one hand, you have a Bitcoin mining operation. That's a business historically characterized by a high volatility, right? It's tied directly to the wild swings in the price of crypto. But then, on the other hand, you have a Tier 1 AI cloud service provider. Now that is a space defined by highly predictable, recurring revenue, but it's also a space that requires monumental capital expenditure. IREN is consciously crossing the bridge between these two worlds. It is a wildly expensive pivot for sure. But strategically, if they actually execute this, it places them in literally one of the highest growth sectors in all of global tech.
To make sense of all this, here is our roadmap for the explainer. We'll be looking at 1. The great AI pivot, 2. Their infrastructure advantage, 3. The Q4 financial paradox, 4. Scaling to 2027, 5. The valuation question, and finally, 6. The final verdict.
All right, Section 1, the great AI pivot. Repurposing for the AI revolution.
You know, when most of us hear the term AI revolution, we immediately picture the software side of things. Algorithms, chatbots, things like that. But the reality is actually much more industrial. AI infrastructure refers to the massive physical compute power and the sheer data center capacity that is absolutely required to run these AI models. And right now, across the entire industry, demand is drastically outstripping supply. Physical data center capacity is literally the ultimate bottleneck in this AI boom. IREN is capitalizing on exactly this shortage. They're essentially arguing that in this new gold rush, you don't just need miners, you desperately need the people building the picks, the shovels, and the power grids.
Moving on to Section 2, the infrastructure advantage, a head start in the space.
The really crucial thing to understand here is that IREN isn't starting from scratch like some brand new startup. They're leaning heavily on 3 critical assets they've built up over years of crypto mining. First, low-cost power. They actually control their own energy infrastructure, which in the wildly power-hungry world of AI is a massive moat to have. Second, data center expertise. Running high-density computing facilities is simply what they do. They know exactly how to cool them and keep them running efficiently. And third, massive scale. Because they are repurposing existing sites rather than waiting years to acquire new land and power permits, they can move incredibly fast. This repurposing is their core argument for why they're so highly capital efficient compared to any new entrants trying to break into the space.
Which brings us to Section 3, the Q4 financial paradox, addressing the elephant in the room.
Okay, transitioning industries is not painless, and a negative $684 million net loss for Q4 is honestly a brutal reality to look at on a balance sheet. But objectively speaking, we really have to look at what is driving it. This massive loss was primarily driven by hardware impairments. Specifically, they're decommissioning and writing down their older Bitcoin mining rigs. They are essentially clearing the physical floor space to make room for new AI servers.
And while the financial hit isn't exactly over yet either, they are expecting an additional $520 million in hardware impairments as this transition wraps up. Now, management explicitly frames these massive, non-recurring losses as a conscious trade-off. To them, it's simply the necessary cost of pulling off this digital transformation. They're perfectly willing to take a short-term hit to their adjusted EBITDA in order to invest heavily in this long-term growth.
But here is where the paradox really becomes clear. Contrast those heavy hardware losses with their surging top-line revenue. While they're writing down all that old equipment, their Q4 AI cloud revenue hit $70.5 million. That's double their previous quarter. On top of that, their full-year AI revenue saw a 7x year-over-year growth. And what's really validating here is that management points out customers are prepaying around 45% of the GPU costs. So this demand isn't just theoretical. Clients are putting down hard cash up front to secure this compute power, which directly helps fund IREN's ongoing transition.
Let's look at Section 4, Scaling to 2027, the Capacity Roadmap.
So this timeline breaks down exactly how they plan to grow. And remember, they already have 85% of their 2026 annual recurring revenue locked in under contract. Right now, their Horizon 1 deployment is already successfully deployed to Microsoft. Looking ahead to late 2026, they're on track to deliver Horizons 2 through 4, hitting 480 megawatts of operational capacity. And by 2027, they are targeting a massive 1,210 megawatts. A huge driver of this aggressive timeline is their stated partnership with NVIDIA, which gives them priority access to next-gen GPUs. In this industry, raw capacity is great, but having the actual high-end chips to slot into those racks is what truly builds the relationships that secure these massive long-term contracts.
Section 5, the Valuation Question, Pricing the Pivot.
I think this quote from IREN management cuts right to the absolute core of the debate. They openly acknowledge that they traded a premium compared to some of their peers, currently sitting at about a 4.6x forward price-to-sales ratio. But their argument is that this premium is entirely justified because they just aren't a speculative mining company anymore. They argue that you have to value them based on that massive $4 billion contracted revenue backlog we talked about at the very beginning, right alongside their blue-chip partner portfolio.
When we look at the Analyst Consensus, we see a really interesting spread. The current stock price is sitting around $40, having come down from some recent highs. But what's notable is that the average analyst target sits way up at $80, which implies a 100% upside. And even when we look at the explicitly bearish targets, like JPMorgan's at $46, which is driven largely by concerns over the debt leverage IREN is carrying to fund this build-out, it still implies an upside from current levels. So the market clearly sees the potential here, but it's also heavily weighing the massive capital requirements needed to actually get there.
And finally, Section 6, the final verdict, weighing the risks and upside.
Look, to truly understand this whole picture, we absolutely have to acknowledge the explicit risks that management themselves are stating. First up, execution risk. They have to actually build these massive facilities on time and keep them running perfectly for Microsoft and their other clients. Second is capital risk. They're carrying debt and tearing down old revenue streams while simultaneously building out new ones, so they have to manage that cash flow bridge perfectly. And third, competitive risk. The AI space is completely ruthless right now, and every major player out there is scrambling to secure power and build data centers.
So ultimately, if you're analyzing IREN, you have to weigh this incredible validation. I mean, having tech giants sign up for $4 billion in contracted recurring revenue against the very real, highly leveraged reality of physically executing this pivot. It's a bold, expensive, and potentially game-changing strategy. But does the guaranteed revenue outweigh the heavy capital risks of getting there? That is the ultimate question at the heart of IREN's story. Thank you so much for joining me for this explainer. I hope it provided a really clear lens into one of the most fascinating infrastructure pivots happening in tech right now.